I'm Michael Waldron, Director of Portfolio Management at Heritage Financial Services. Thank you for watching our presentation of the real deal economy. Financial markets and the economy don't obey the calendar year. We tend to discuss themes starting January 1st, extending through December 31st. Then we wipe the slate clean and start over. Themes are more fluid. Some cut through multiple calendar years, and there are inflection points scattered at times throughout the year. I would argue that the third quarter of 2023 is one of those inflection points. Fixed income investors changed their mindset from nearly 18 months focused on the terminal federal funds rate to finally adjusting long-term expectations of the U.S. economy in a state of equilibrium. The key question has changed from how many rate hikes to how long are we on this road? We all remember the yield curve at the beginning of 2022, positively sloped and anchored just above 0% at the short end. After an aggressive year of rate hikes, the curve ended 2022 significantly higher at all maturities, positively sloped for the first year, and gradually inverting towards an equilibrium short-term rate between 3.5% and 3.75%. The focus for the first half of 2023 was how many rate hikes. At the end of the first quarter of 23, the yield curve illustrated in the orange showed a lift in short-term rates and a decline in long-term rates. Yes, the Fed will hike some more now, but we're not worried about a higher rate level lasting for a long period of time. At mid-year, the yield curve had term rates past 5 years nearly identical to where they were at the start of the year. We're still heading to the same place, with the short end of the curve higher still. How many more? How many more? How many more? And then we hit the third quarter. The short end remains stable through the 2-year point. We're no longer asking how many, but the curve began to rise materially for longer maturities. The mindset shifted from a very short-term focus on the Fed's changes to the target federal funds rate range to the possible long-term scenarios that may result in interest rates remaining above 4.25%, even in the long term. While inflation has steadily decelerated since the summer of 2022, it once again started accelerating in the third quarter of 2023. Will policymakers be willing to inflict the economic pain that might come to bring inflation down to the 2 to 2.5% target? Or is the new inflation rate, as far as the eye can see, going to run above 3.5%? If so, we might be on this journey for longer than we anticipated. Might 4% plus be an equilibrium short-term risk-free rate, not just now, but a quarter century from now? The market and the Fed agree that we're near the end of rate increases. There are not many more coming. But will the Fed be able to ease policy rates without aggravating inflation? If a pause caused a pickup in inflation, is it credible to see the Fed rate under 4% in 2025? The Fed thinks so. The market doesn't. The Fed's long-term projection of 2.5%, are we really going to be able to take off 3% without stoking the flames of inflation? The yield curve doesn't reflect that. The narrative to me is that in 2022, inflation was higher than expectations, causing the Fed to rapidly raise interest rates, which drove both stock and bond prices down. In the first half of 2023, inflation was falling towards target. The focus was on how many more rate hikes there would be before we started easing, and stocks and bonds were materially positive. In the third quarter of 2023, inflation stopped coming down. The Fed is on pause, or might hike one more time, which in the grand scheme of asset pricing doesn't really mean much. And the market is adjusting its long-term expectations for higher rates for a longer time, which both negatively impacted stocks and bonds, erasing over a third of the stock market's gain during the first half and bringing bonds slightly negative for the year. So how do we think about this when we build a fixed income allocation? Long-term bonds are pricing in a pessimistic long-term outlook. Implied forward short-term rates above 4% either mean a healthy real return or economic policymakers have a long-term inability to achieve their target inflation rates. When markets show frustration and begin to be somewhat dramatic, Rick Santelli starts to say that the 10-year could hit 13%. It's not a bad idea to lean in. Think about the risk and return on a 5-year treasury. If the 4-year rate increases by 1%, while the 5-year bond collects 1 year of interest and turns into a 4-year bond, its total return would be nominally positive. If the economy softens as more consumers feel the impact of the new higher rates, for instance, my wife and I just decided not to move forward with a car purchase due to financing rates, and the 4-year rate decreases by 1%, while investor collects their healthy rate of interest on our 5-year bond, the total return would be 9%. Fixed income with some reasonably extended term component makes a lot of sense in a diversified portfolio today. While stocks are well off their highs from the early summer, the absolute return is still strong. Going into 2023 with an attitude positive towards equity market risk was the right call. We pivoted mid-year after reaping much of the reward of coming into 2023 running hot and cooled off our volatility targets. I anticipate if the environment continues the way it looks now, that we will move more of our allocations towards fixed income for an attractive return at a fraction of the risk of stocks. Remember that financial markets don't obey the calendar year? That's true for style investing too. I know tech and communication services have had a great year in 2023, and that has led growth to significantly outpace value year to date. But remember, that's not a leadership story. Growth stocks had a miserable 2022. Look over the past 21 months, and value has provided nearly 6% in downside protection, a better return, and far less volatility. How are we positioning investment portfolios at Heritage? We reduced our exposure to real assets, predominantly, and alternatives to a lesser extent, at the end of 2022, and added to stocks and bonds. We reached mid-year, and we decided to take the edge off of our stock allocations and add more to bonds. We're slowly increasing the duration of our bond portfolios, and I anticipate if the market continues to price in higher rates for much longer periods of time, we'll lean into the attractive yields and increase the maturity of our bond portfolios. And we plan to maintain our bias towards value stocks. They have avoided significant downside over the past 21 months and accomplished it with a much smoother path. So what's the real deal? Be excited to invest in 2023. The return opportunities are good, and you can get a healthy return without having to push too far out on the risk spectrum. In bonds, inflation is covered nicely by current yields. The risk is shifting towards reinvestment, with intermediate and long-term rates perhaps a bit higher than they ought to be. Fixed income should play a full role in portfolios today. The base yield isn't too far off of expectations for what equities might return, and they're likely to provide a very different path of returns. And styles are noisy. Despite the tech and communication services comeback, a price-aware value investor has had a much better 2022 and 2023 overall. Thank you for your time, and I hope you tune in next quarter as we dig into the economic data and sort out what to ignore to get at the real deal.